Okay, let's turn the sound off on the phone. Never had that happen. Yes, sir. Okay, good morning. I'm sorry, I had a technical issue. My phone started talking to me. It's a fun thing to have happen first thing in the morning. Thank you all for coming, and for those of you that are online, thank you very much for waiting. Every year in December, I do I call it our thank you breakfast, and take some time to thank the Finance Committee and all the other team members, underwriters, advisors, everyone that works with us. So we had breakfast this morning from 8 to 8:30, and we're going to get started now. And we have a special speaker, and I'm hoping the committee will give me some indulgence, because normally I make some comments at the beginning, but I want to get Jeff Rao up and going first thing in the morning. I told him we'd get him started at 8:30. Jeff Rao is with PFM Asset Management. He is the person that I see quarterly that does the market update for Florida Palm, for the money market, for the investment pool that we're a member of.
Can we do an introduction though around first
Certainly, certainly.
before we do that?
Doug Draper with B of A Securities.
Yeah.
Matt Sandsbury with RBC. Steve Lenahan, Wells Fargo.
Rick Patterson. Sorry.
John McCauley, JP Morgan.
Rick Patterson with Raymond James. Mike Baldwin with Jefferies.
JW Howard, Morgan Stanley.
Michael Kohner, committee member.
Bill McDaniel, Emeritus, committee member.
One more citizen member of the Finance Committee.
Rick Miller, member of the Finance Committee.
Laura Howe, PFM Financial Advisors.
Leanne Evans, School District.
Heather Frederick, Chief Financial Officer.
Richard Pengelly, PFM Asset Management.
Scott Sweeten, PFM Asset Management.
Leslie Allison, PFM Asset Management.
Barbara McQuinn, School Board Member.
Blair Littlejohn from the Office of General Counsel.
Welcome all. Okay.
Okay, so Jeff, are you on the call?
Yes, Leah, good morning. Can you hear me?
I can. So Jeff is the person that I get to talk to whenever we are meeting about Florida Palm. And I've heard the committee over the years say, we really need to know who's running the pool, who's running the investments from money market. And I wanted you to have a chance to see the level of detail that I get to see in that quarterly investment report. I actually get to meet with him twice, because I'm the chair of the advisory committee, so I also get to attend the Board of Trustees meeting, and Ms. McQuinn serves as a member of the Board of Trustees, so we get to see this frequently. So, and I know that, Jeff, I'm going to start this off, and I'm going to let Richard chime in, because I probably won't say it right. You can't show us the exact same presentation I normally get for compliance purposes, so I think we're seeing the market update and then representations of what we see regarding Florida Palm. And is that correct?
Yes, Leanne, that's well said. Yeah, just out of fairness to all of the investors, we are limited in how we present information about the pool. However, Jeff is head of our short desk and oversees all of the pool LGIPs that we manage all across the country. I think we're up to 18 of them, or in 18 different states. So he will talk through a lot of the things that he sees and thinks about in managing those pools.
And I just want to remind the committee, if you have a question for Jeff, you have to speak into the mic and make sure the green light is on, because if the light's not on and you're not talking to the mic, he won't be able to hear you. So I expect some of you are going to have questions, so I just wanted to make sure I said that before we get started. So Jeff, I have your presentation on the screen. So if you want to tell me when to shift slides, I'm happy to do that.
Yeah, that'd be great, Leanne. And just a heads up, my Teams link, the Google Meet link was not working for me this morning, so I'm just on audio. So I'll have to refer to slide numbers and trust that the group can see the same slides I'm following here.
Okay, and I've got Richard here to tell me if we're on the wrong slide too. So we also have Scott Sweeten and Leslie Allison here from PFM that all work on the pool. So hopefully between the group of us, we can stay on the same slide you're on.
Great. Well, thanks again, Leanne, and I'll get started if it's okay. I appreciate the invitation today and happy to be here. We've separated the discussion this morning into two sections. The first section is a market update. Exactly kind of what Leanne would see at her board level meetings. So I'll go through the market and the economy, talk about what's changed recently, how it impacts short-term yields, and specifically investments that you're typically invested in. And the second part of this presentation is kind of unique for the group today in that we have kind of a general local government investment pool overview. And you can let me know as we go how much time or how much detail you want to get into. But we've got two things planned, and I'll get us started on page 2 with the market update. And we're going to kick things off with a talk about inflation, a talk that's, of course, very painful to many at this point. We all kind of know in our day-to-day lives how inflation has taken hold here in the United States this year and what that means to consumer prices. And I think we all kind of know and see the high-level CPI numbers that have come in. CPI peaked above 9% this summer and has started to move in the right direction, lower, but has a long way to go. Beyond kind of that high-level number that you're probably used to reading, a few takeaways we wanted to make for you today. And the first is, where is inflation coming from? And this is really important because at times the Federal Reserve can overlook inflation that's temporary, and there are certain areas, contributing factors of inflation, such as food and energy prices, which over long periods of time tend to be volatile. They can be affected by short-term swings in things such as weather-related events or geopolitical situations. And the takeaway for inflation currently is it's well beyond kind of those volatile segments. And inflation's found its way into goods and services and really every part of our economy. And a year or 18 months ago, the Fed did not think that was the case. They thought inflation would be transitory, was more supply chain driven. And of course, with the value of hindsight, we've seen that that was not the case, and inflation has taken hold. And that, of course, is the main reason our Federal Reserve has turned so aggressive in monetary policy and raising rates this year in an effort to slow our economy and bring down inflation. So a lot of what we talk about when we meet with Leanne and the group is the Federal Reserve, what they're doing on monetary policy, how that drives short-term rates. You can see on this same chart not only kind of where inflation has been, but we have on the right side of the page where economists believe inflation is going in the coming quarters. And the takeaway here is inflation is not going to come down overnight. It's likely to take many quarters, likely to the end of next year or into 24, until we get inflation even down to a 2 to 3% level at best. So the Fed's, I think, encouraged to see movement in the right direction, but a long way to go. The next page, we just want to acknowledge briefly kind of the economy currently has some headwinds and tailwinds. So it might seem like things are pretty dour if you look at the headlines, fears of slowing growth, fears of a recession, certainly large declines in asset prices this year, whether it's the equity market or bond prices. It's been a tough year for assets, and that leads to a lot of uncertainty and concerns to the consumer. And consumer sentiment is certainly down in the upper right-hand chart, helped by some of that fear in the marketplace, helped by the fact that borrowing costs to buy a house or buy a car are much more expensive than they were. Fears of inflation persisting or job losses to come, that's soured sentiment. Home sales in the lower right have been affected by rising mortgage rates. A 30-year mortgage recently hit 7%. Just think back a year or two ago when that was 3%. So we're acknowledging there are headwinds, but there are some strong, kind of foundational elements of our economy that we should keep in mind. Really, the most important is the unemployment rate below 4%. Maybe if we could go to the next slide to talk about our jobs market a bit more. I'm on slide 4. And this is, I think, a blessing and a curse to the Federal Reserve. So you might say, why is that? The Federal Reserve has an objective to have low unemployment and have Americans at work. It helps our economy, and that, of course, is true. But the Fed is not focused on the jobs market at the moment. The Fed's focused on inflation. And the Fed's number one job right now is to bring down inflation. And when you kind of step aside and look at the jobs market and how tight it is, how hard it is for employers to find workers, that creates a jobs market which is inflationary. So employers are paying up to get workers. That adds to the upward pressure on inflation and makes the Fed's job harder. So kind of what I'm saying here today is this is, I think, a kept secret of the Fed that they're starting to acknowledge that they're going to have to see the unemployment rate rise, which they typically don't like to do, but they're going to have to likely see that occur in order for inflation to come down. So that is becoming more apparent recently, and that's why the market's really focused on hourly earnings and employment metrics related to compensation. Let me pause there so far, make sure there aren't any questions in the room before I continue.
I think everybody's good, Jeff. You can keep going.
Thanks, Leanne. So we've talked about inflation. We've talked about the labor market. Now, what is the Fed doing? I'm on page 5 now. What is the Fed doing to combat inflation and help our economy forward? The Fed releases this projection after every other meeting. So about 4 times a year, the Fed puts in place expectations on where they believe key metrics are going in the coming quarters and years. And the Fed has acknowledged our economy is slowing. So in the upper left-hand chart, you see at the most recent release in September, the Fed expects growth to barely be positive this year, to be just over 1% next year. So the Fed is acknowledging that growth is slowing, and it's frankly intentional. The Fed's trying to slow our economy to bring down inflation. That's job number 1. On the lower right-hand side of the page, we highlight what the Fed thinks the overnight rate will be going forward. And it's higher than they thought last time they met. And that's been a theme all year. The Fed's been behind the curve. That's why you see the overnight rate started this year at 0%. It's about to go to 4.25 to 4.5 next week when the Fed meets again. So the Fed is taking this historic move and moving rates higher in a very short-term fashion to slow the economy and bring down inflation. I'll skip ahead to page 7 if I could, where we look at the Treasury yield curve. So here we're looking at Treasury securities from 0 to 30 years and kind of looking at how that's evolved over the course of this year. So the yellow bar is, the yellow line is the current yield curve, and we compare that to June 30th and December 31st of last year. And the takeaway is simple: higher rates. Rates have moved higher throughout 2022 based on that same inflation backdrop I described. So the Fed continues to raise rates to combat inflation, and that's created higher rates across the yield curve. Now, when you talk about the types of investments that public entities typically invest in, a money market fund or a local government investment pool or a separately managed account, it's really that 0 to 1 year, 0 to 3 year type environment we're talking about. And those rates are really where we're seeing the highest rates right now because they're most directly impacted by the Federal Reserve's rate hiking campaign. Page 8 shows you kind of how quickly things have changed. So on 8 here now, you can see a 6-month Treasury versus a 2-year Treasury, and then the Fed funds rate, that rate that our central bank controls in yellow. And you can see how quickly we've come off of 0. So from the perspective of someone that has idle cash, this is a good place to be. If you have money sitting, you can actually earn a rate of interest that you haven't been able to really earn in this type of level for 15 years or so. From the eyes of a borrower, of course, higher rates bite, and they make it more difficult to take out a loan to build a school or buy a house in the case of an individual. So that's kind of the reality of what the Fed's trying to do here. I'll close up our market discussion on page 9 if I could. And this is really, the most directly related slide to the types of investments that we purchase for on my team, on our trading desk for local government investment pools and short portfolios. And that's looking at under 12-month maturities. So on the left side of the page, we're looking at treasuries, agencies, and then commercial paper in yellow. And I always like to, when I'm describing this slide, I like to tell the group, we all know at this point in the discussion that higher rates are here. The takeaway from this slide isn't just the absolute level of rates, but it's the relative value in certain sectors that are high quality. So commercial paper in yellow is offering currently a very attractive spread versus treasuries and agencies. And that dynamic does not always exist. The right side of the page kind of shows you in basis point format, how large that is. Leanne and others that may have been around this a long time know that if you can get 50, 60, 70 basis points on commercial paper over a treasury, that's a wide margin. In normal times, that's maybe 10, 20 basis points. So a big theme we've talked about this year is the attractiveness of this money market sector. Again, not in absolute yields, but in commercial paper and kind of relative value opportunities. So let me pause here, see if there are any questions. And then Leanne, you can let me know how much time and depth the group wants to go in the next section.
Okay, does anybody have any questions so far? I don't see any. As we go through it, I know this includes I think they know what the local, I'm going through the slides right now on the screen. I think they all know what a local government investment pool, we've talked about that before. But when we start talking about, and GASB 79, I think we can touch on that. I think that's important, especially this group all lived through the challenges with the SBA years ago when they shut their doors for a while. And that's why this pool was created. So GASB 79 really helps address that and the types of investments that we can purchase. So I'd like to talk about that a little bit. And then this is the local government investment pool that was created after there was the problems with the SBA. So I think that's good to get into, and I'd really like them to see the stress test. I think they'd like to see that as well.
I wonder if, just to go back in your, the earlier speaker, maybe ask him to comment on the relative importance of monetary contraction versus the manipulation of the federal funds rate and the control of inflation. In my humble opinion, turning the spigot off for the free spending federal government would be by continuing to ratchet down the creation of money out of whole cloth would be.
Printing money is a problem.
Printing money is fundamental. I'm a Milton Friedman devotee, as you can imagine. So I'd be interested in having him comment on the relative importance of the two.
Okay, Jeff, you were able to hear that, right?
Yeah, good question. Happy to address it. So you kind of think about where we are currently and the kind of complications we face with inflation and kind of the volatility we've seen in asset prices in recent years. And I think you can kind of begin to, there's the fiscal side and there's the monetary policy side. But I think I want to kind of focus our attention on kind of the impact of COVID and the COVID response and kind of what that created. So think back to March of 2020 when the global economy and the U.S. economy were effectively shut down instantly. That was, kind of completely unprecedented to just say, people are not going to travel or conduct business in the way that they were used to. And that shutting off an economy created tremendous uncertainty. It sparked significant job losses with the unemployment rate spiking to 15%. And it was received with unprecedented response from both fiscal and monetary authorities. So on the monetary policy side, what did the Fed do? They cut rates to zero, and they instituted quantitative easing. That is, they're buying long-term treasuries in a very big way, billions and billions of treasuries in order to artificially depress yields, in order to make it easier to borrow, to stimulate the economy. So the Fed is doing everything they can and everything they can think of putting together to stimulate the economy in unprecedented times. The fiscal authority also kind of went in place and kind of threw the kitchen sink, if you will, at the situation by providing tremendous amounts of stimulus to individuals and businesses and local governments. And as we've seen over the past 2.5 years, the economy has reopened, inflation has taken hold, and it seems obvious at this point that the amount of stimulus turned on during that period, whether through monetary policy or fiscal or both, led us to a result where inflation is out of control. And that's what the Fed's trying to correct, the kind of overstimulation of the economy. I do think some of the excesses created by quantitative easing have begun to work their way out of the system. If you look at kind of cryptocurrency as one example and kind of other asset bubbles, I think the Fed would be pleased at kind of what they've seen in that that sort of froth is being let go from the system. But there's tremendous work to be done to get back to what I would describe as kind of a normal place for our economy.
Okay.
Well, I mean, just to follow up, just the last question. Do you think that relatively, manipulating the short-term interest rates versus the monetary contraction, which is more important? In my view, getting the Federal Reserve out of providing unlimited funds via monetary easing is a major problem, and it has to be cured. And the size of the Fed's balance sheet has to be dramatically reduced. And so, ergo, as long as that's hovering over us, we're never going to bring interest rates down or to any meaningful way.
Yeah, the massive balance sheet is certainly can be pointed to as a driver of many of kind of the distortions we've seen. I mean, the balance sheet is now beginning to shrink, but that takes a long time. I think what you've seen in asset markets, crypto and others, is a bit of that air being let out of the balloon. I think as the Fed's balance sheet continues to shrink, you'll see things hopefully begin to normalize a bit from an asset price standpoint. Without crashing is the hard part.
Okay. So Jeff, do you want to go ahead and touch a little bit on, or if somebody wants to touch a little bit on GASB 79, and then I'd really like to see them to see the stress test and see how we testing the portfolio on a regular basis.
Yeah, certainly, Leanne. I'll make, we don't have to go through each of these slides. The comments I'll make around GASB, I'll keep high level, and that GASB has kind of always been looked to by those of us that manage local government investment pools to kind of standards of what, how we should kind of think about managing portfolios that have this objective to achieve a stable net asset value, right? So I think anyone who's in the fixed income market saw from this year, when bond prices move, when yields surge, bond prices fall, and that creates, real market value losses. But in our space, in the money market type or local investment type funds where you have 60-day and under weighted average maturity, really short duration, our core objective is to not lose money. And despite the historic volatility we've seen this year, money market funds and local investment pools have not. They've been able to achieve that stable dollar objective, and they've really been the place to be this year from an investment standpoint in this historic interest rate move. But the reason for that is there's a number of risk mitigating factors in place. So historically, GASB tied our rules to money market funds that were registered with the SEC. Of course, money market funds and some local investment pools around the time of the financial crisis got into trouble. And the industry was strengthened through a series of reforms, and most recent in the kind of 2014 to 2016 timeframe. But the importance there is GASB maintains what we think were some really core principles around minimum amounts of liquidity that we continue to manage by. And kind of one thing we talk to when we talk to public clients is you really want to understand the local investment pool that you're invested in, and not just, it's a pool with a nice website and it has a rating, but kind of what's the investment philosophy, what's the risk tolerance of that fund. And we kind of pride ourselves on the liquidity and safety side of things. And we follow GASB 79, which has some key metrics. I won't go into the details, but a lot of it's around minimum amounts of liquidity and safety at all times. And we kind of compare and contrast on 14, for example. You can achieve a AAA rating without having a minimum amount of liquidity in a portfolio. So there are other funds out there, even in Florida, that do this. They have a high rating, but don't follow GASB. And that's not our approach. So we kind of educate clients on that reality. On 15, I'll spend more time on this if I could to close out. And that's a look at a stress test. So this is one snippet of what is probably a 10 or 12 page document that Leanne looks at quarterly, where we stress test the portfolio. And what that means is we look to see what it would take as far as hypothetical market movements for that net asset value to move away from $1. So again, our core objective in managing these local government investment pools is to not lose money. We want investors to put $1 in, get $1 out, and earn interest. So these tests we run, we do it at least monthly, is looking at interest rate changes, credit spread changes, credit downgrades, investor outflows. So that is if investors come into this fund and say, I want my money back, and how that impacts other shareholders. And we see that resulting impact on the net asset value because we want to make sure there's not a realistic scenario where things could become impaired. So the full test, that we would show would have a liquidity analysis section, look at investor characteristics, historical trends. We would stress the portfolio from a variety of angles. This is just, again, one page aimed to kind of show you what we think about, but it's a very thorough process and a lot goes into it. I know you have a lengthy agenda today, so I'll stop now and see if there are any questions kind of on the local investment market and kind of how we think about managing funds in this space.
Can you summarize GASB 79 for us, so at least for me it's understandable?
Sure. So by following GASB 79, we have to follow the criteria that's set out in GASB 79, and that criteria says the portfolio must have a certain amount of liquidity, certain amount of or limited amount of duration risk, so a 60-day weighted average maturity maximum, 120-day weighted average life maximum. There are standards we have to do that, and as long as we follow those standards, we are allowed to let investors transact at $1 in, $1 out. There are some managers out there that are doing these local government investment pools that have a loophole, and they don't follow GASB 79. There's another carve out that says you can manage local investment pools not having that same amount of liquidity as long as the underlying investors report market value on their financial statements. So investors in our funds can rest assured, we're striving to meet a $1 in, $1 out objective, and they can report their holdings in local investment pools at par. They don't have to mark to market. Those that are invested in other funds should, by this requirement, report at market value, which might be less than $1. Not sure if I did a good job explaining that, but let me know if you need me to elaborate.
Okay, helpful, thank you.
Yeah, I think that everybody's got it. I'm seeing nods. Okay, and I would comment that when we get the package of information, as Jeff said, the stress test is probably 15 pages. There's a lot of data there, and you're not seeing all that data. But I wanted you to have a chance to see the level of detail and the work that's being done in managing that pool and other pools. So right now we invest in 2 pools. I've got several others knocking on the door, and we're going through the analysis of each one. I want to make sure that they're all following GASB 79, that they have the same level of due diligence. I'm much more comfortable with Florida Palm because I'm in those meetings. And I have to tell you, we go to those meetings, and I ask questions, and Jeff updates his market updates. So the next time he's answering my questions before I have to ask, and they make changes based on things the Investment Advisory Committee asks for, and I find that very helpful, and it makes me much more comfortable using that pool because we have that level. I was just on the phone with Leslie yesterday making a suggestion of something I'd like to see on the website, and they're going to do that for me. So having that the ability to have those conversations and talk about how the funds are being managed is really valuable. And I appreciate the opportunity I've had to do that over the years. I think we were the first entity, if not the first, maybe the second, to invest in Florida Palm. And I've been on the advisory committee the entire time, have no intention of stepping back unless somebody tells me to. I enjoy hearing the market update and getting to see this data. It helps me understand the pool, but also helps me with the rest of the investments that we do for the school district. So I think it's very valuable. And I really appreciate Jeff's time today and hope you've enjoyed hearing the market update. Slightly different way. A lot of the same information you've heard before, but it's just a different format. And I think it's helpful.
Another question. If you don't follow the guideline of 79, did the auditors show that in their audit?
If it was not compliant with GASB 79, then we would have to do the mark-to-market update in the financial statement and show the true value, which could be higher or lower than $1. I know on behalf of our accounting department, they're very grateful that we follow GASB 79. It makes it a lot easier to do the financial reports at the end of the year. It's easier for me to manage the money. And remember, this is overnight investments as far as I'm concerned. If I'm putting $1 in and I'm planning to use that for payroll next month, I need to know I'm going to get $1 back plus interest. That's not investing in something that has a floating net asset value for short-term money is just not an option for me. I mean, that's money that I'm going to use in the next 2 weeks to the next month. I need to know that money is going to be there. And then with our other securities that do have the asset values change, and when we're in a rising interest rate environment the way we are right now, we spend a significant amount of time looking at cash flows because when I'm buying those securities, we're laddering them out to set them to mature when we need the cash so that I'm not having to sell into a rising interest rate market where we could take losses. So we're actually working on cash flows. We have been all week, and I'm hoping to wrap them up today and get them to PFM. Later today, we have a call scheduled for Monday to actually plan out the investments because tax revenues arrived earlier than expected this year. We've never had them this early, so we've got a bunch of money that's in pools and money markets and in bank accounts right now that we need to shift out to securities. So we'll be doing that next week. So I rambled a little bit, but hopefully that was helpful.
It was helpful, but I want to kind of harp back to Bill Moore and years ago, PFM, when I think it was the state, all the local government.
Right, it was the SBA that we talked about.
Okay. When,
Sorry?
if you recall,
Oh, yes.
you raised the problems, and so did PFM,
Yep.
about them taking short-term money and investing them in mortgages and such.
Right.
I mean, that's what we were talking about. And I guess this is the reaction to it.
Well, that's one of the reasons is, GASB 79 was put in place. It wasn't specifically the SBA. There were also problems with money markets, and this is the version that applies to local governments. But this was the market reaction to it. And I remember that day very clearly, and I expected, today is the last meeting for Mr. McDaniel. It was also the last meeting for Steve Alexander, and unfortunately has the flu and is not able to be here. But I figured we'd spend some time today talking about what happened with the SBA and that meeting when Steve had sent out on behalf of PFM, here's the holdings, and I brought it to the committee, and I remember it like it was yesterday when Mr. Moore said, Leanne, we need you to put your sneakers on and run upstairs and do it right now.
Get out of that pool.
And we did it on the screen so you could all see it. I do remember that like yesterday, and
Did you have your sneakers on?
I didn't, but I didn't have to run upstairs.
Our
I just
wallet
did it
every
here.
cent.
We
Bill
just,
asked, how soon can we get out of it? In an hour? Something
Yeah.
like that?
yeah.
All right.
We
It
were out.
was
We
a,
were the first ones out.
Well, yeah, that's right. No point in taking, this is not money you're investing, you're, investing, you're simply parking it for a short duration.
Right. Yeah, so we're grateful that we pulled out. I'm grateful for the advice of this finance committee, and I know we're going to move into the annual investment report. And I've got thank yous embedded in all the annual reports because we really do appreciate the value of all the information that we get from the finance committee and from this whole forum, where we have our advisors here, we have the committee members, we have a board member here, we have other people coming in from banks, from underwriters, and we there's a question I'm going to raise today during the debt report that I'm going to ask a question about. So it's great having this wealth of knowledge at this meeting quarterly, and I really enjoy these meetings and very grateful that you all attend. I think, Jeff, we can turn you loose. Any more questions for Jeff?
Yeah, no,
Thank you very much, Jim.
very nice presentation.
Yeah, we appreciate you joining us, and we don't usually get him, so that's something I've been working on with Steve and with Richard. Can we arrange to have Jeff give a market update? I just thought it would be good for you to hear what I get to hear, and what Ms.
Yeah.
McQuinn gets to hear.
Happy to join today. Thanks for the invitation, and I apologize if the camera troubles weren't working. We'll get that sorted out for next time.
Okay, perfect. Thank you
Take
so
care.
much, Jeff. We really appreciate it.
Sure thing.
Okay, so I'm going to go back to the agenda. And the other two things on the agenda is the annual investment report and annual debt report. Before we start those, I did want to take a minute to recognize Mr. McDaniel. Dr. McDaniel, this is his last meeting. Actually, he retired, and I called him, convinced him to come back today.
This is a
So-
celebratory
Yeah, we
retirement.
really wanted to thank you for, he's been volunteering. I tried to figure out the date. You said 26 years?
1996.
It's been
And
quite a
the-
while.
The predecessor committee, was that just called the investment
It was
committee?
investment committee.
Yeah, and then it morphed into this.
Yep.
And I certainly thank all the committee members, including those who are not here. I learned a lot from all of you.
Well, you're very much part of it, and you were
Indeed.
part of that day when we're talking about right here with
Yeah,
Bill Moore, the
exactly.
Bill and Bill.
That was pretty
So-
exciting.
Right.
Thank you.
And we do have a little gift for you.
Well, thank you.
And it's open, it's at the top, so you can pull it out, and the box
well,
is down below for storage.
I'm gonna need to wrap my wife's gift, so this will be a nice.
It's just an old treasury bill that we couldn't, didn't know what to do.
Got a box
Very nice.
with my name on it, and I assume cigarettes?
Not quite.
Thank you.
Thank you very
Very
much.
nice. That's very nice.
Got a
box,
clock?
yeah, thank you.
Well, on behalf of the school board and the school district and staff, thank you very much for your contribution to the kids in Palm Beach County.
Very nice indeed.
I think we should do a
Get you out of-
resolution
I'd
in
read
favor
that,
of
we'll be
Bill.
all set.
I think we should have a resolution in your honor,
Resolution.
honoring you, yes.
Should I,
So moved, yes, by all means.
So we got a motion and a second, resolution honoring your 26 years of
Thank you.
excellent service to us and your comradeship. We all appreciate it very much.
I will
And let's
miss
put
the
it on
folks.
record.
I will not miss the drive.
Well, you're looking well, I have to say. It's nice.
Yeah. Well, thank you very much. We really appreciate it. I'm so grateful you came back today so we could do this at the meeting today.
And I was on a cruise lately, and the scrambled eggs were terrible. And these were delicious today.
Ed has a secret recipe, you see.
I'll pass that on to, breakfast was catered by the cafeteria here in this building this
You did
morning.
a nice
so-
job.
Yep.
Yes, thank you. So congratulations,
Yes,
Bill.
indeed.
Thank you.
Okay, so I'm going to jump back in, and we're going to go into the annual investment report. And most of this report you have seen before. It's got all the reports that you see quarterly. This was the June reports. But we put an executive summary together just to, and this will go to the board. We'll be sending this out as the annual and file. It's on our website. So back in 1972, they adopted the investment, it was an investment policy back then. Now we call it an investment and cash management policy. It's been amended many times over the years. The last revision was in 2017. We bring that policy to you annually, but the changes have been Scribner's errors. There really hasn't been any changes. It's now been 5 years, so we are going to bring that policy back probably at the next meeting to update it, make sure there's no changes. And even if it's just Scrivener's errors, I think it's time to bring it back to the board just so that it's been refreshed and we have a more recent date. We'll be doing that with the debt policy as well. But the priorities, of course, is safety of principal, then liquidity, and then the return on investment. That's the three rules we live by. But the policy is really the roadmap of how we manage the investments. And we were in compliance with all requirements during FY22. We break down the cash and investments in three categories. It's overnight and then short-term securities investments. That's what we're asking PFM to buy treasuries, agencies, commercial paper for. The overnight is money markets, local government investment pools, and bank balances. Although we try to keep the bank balances low, it's quite a bit there right now, but we'll be investing that shortly. And then we have the core investments, and that's 1 to 3 years. That's money that we typically are not going to spend unless there was an emergency. That is the district's board contingency policy, along with some other, we do an analysis every year and look to see over the last 5, 10, 15, I've been tracking this for years, to see how much money sits and what the average fund balance is, month by month. So we look at that, and that goes into the core investments. It was 86 for years and years. We dropped it to 50 at one point. It's up to a little over 100 million right now. That's something that we need to look at right now. That number probably needs to be a little higher, but it's going to come back down once the ESSER funds are fully spent. So it's something we need to look at regularly. So I added to this year, I added a section about the bank accounts because it's our investment and cash management policy. We do have many bank accounts, including one for every school. So we're up to 180 bank accounts that we're managing right now. And my department, primarily Brenda Giampetti, who is hiding in the room behind us, acts as the customer service desk for the schools. So our schools are not allowed to call the bank. They call us. And we do that to make sure that we know if there's any issues, if there's a problem with the bank, that we can let them know and be proactive, or if training is needed with bookkeepers, because we do get new bookkeepers from time to time, and that becomes an issue every once in a while. And Ms. McQuinn, you have a question?
Actually, I have a comment. I want to make sure that everyone knows that we have a very strong audit committee.
Yes, we do.
So they look at all of these school reports very carefully.
Yes. We do use every fraud prevention tool that banks have developed. We use them all. And I threw this in during 2022. We had 392 exceptions that came up, and 159 of them were fraudulent and were returned. So we do have regular fraud, people trying to steal money from the district, and we have tools in place to prevent that. So no unauthorized transactions pass through the controls we have in place at the bank. So I just think that's good information to know. Sometimes it is fraudulent checks. Sometimes it's fraudulent ACH transactions. We have people that try to pay their phone bills through a bank account. They get a check from a school, and they'll use that check information to say, I'm just going to use that account to pay my phone bill via ACH, and it pops through. So we have protections for that. We see checks come through where they've washed the maker's name and put something else in it. We see them where they've just printed checks and put our bank account numbers on them. They don't even look like our checks. They have different people signing them. You name it, we see it, and we have tools in place that will prevent those from going through. So I'm very proud of that we've been able to put that in place. And it's constantly changing and evolving. The fraudsters do nothing but this all day long, and they're constantly trying to find ways to steal money. So I work very closely with our bank. As they develop new tools that are useful for us, we will add them on. Because just like with our investments, I have to make sure that all the money we have is available to use to pay our bills, not to go to somebody else's pockets. So that's important. And then I gave you a brief overview of the market. We did FY22 started with interest rates near zero. By December, this time last year, when we were getting ready to do the investments, we could see that rates were going up. The yield curve was already showing rising interest rates. So we laddered out the short-term portfolio. We did see rates start to rise from March to June. It was up 1.75% and continued to rise ever since. You just saw that in the market update. As securities matured, we thought we were going to reinvest them at the time in December. We actually planned for some things to mature in 3, 4, and 5 months, and we were going to reinvest. But the Fed was taking action so quickly to change rates constantly. We really took advantage of the pools and money markets that could adapt more quickly to capture rising interest rates as they occurred. We're going to be looking at that on Monday to see how we're going to manage the money that's come in so far in December, and there's more expected later this month. So December, we spent a lot of time looking at cash flows and what do we want to do this year? And do we want to, we have in the past bought securities that will mature out to September and October and November, up until the new tax revenues come in. We may do something slightly different, keep it relatively short and reinvest. It's looking at what we think the Fed's going to do. And as I was telling Richard yesterday, in one of the many conversations we've had this week, I really do have a toy crystal ball on my desk to remind me that we don't know what's happening with the market. We have to go based on the information we have and use the information and make our best decision based on that. So we'll be working on that Monday and get all these dollars invested. So I have below a chart just showing this was FY22, and green is bank balances, whether it's in our lead bank or with our custody bank. So you see it spikes up. We transferred money to the custody bank, and then investments were purchased over a couple of days. So you see a spike, but otherwise it's typically low. We let it round up when we think something's going to happen. I think this was getting ready for a retroactive pay raise that was going to hit. But typically we try to keep the bank balances relatively low. Everything in blue is money markets. The dark blue is money markets. And then we have local government investment pools that are the first two is Florida Palm, and then Florida Palm Term, and then the SBA. And then the orange color or tan is the short-term investments. That's the treasuries, agencies, commercial paper that we purchased through PFM. And the dark rust color is the core portfolio. So that core portfolio stays fairly constant. What I'm thinking of doing is taking a lot of the invest more in short-term securities this year. Again, we let this kind of spike up and moved around during the year. It was a challenging year to do investments because the Fed was constantly changing the rules on us. So I think we're going to have a fun year going forward as well. But this is what we did for FY22. So as of June 30, 2022, the core had an invest portfolio with a par value of $109 million. Market value was $107 million. That difference is the result of the rising interest rate environment. It's just as the interest rates rise, the value of the securities decline. But we haven't had losses on them. It's just the mark-to-market transaction calculations that we do. The total return on that portfolio was a negative 3.16%, which was better than the benchmark of negative 3.3. Again, that's all due to the interest rate environment that we were in at the end of the year and continue to be in. The duration of the portfolio was 1.52 years as compared to the benchmark of 1.78. And PFM has talked about that on numerous occasions, keeping it shorter than the benchmark, so it's easier for them to react to the changes the Federal Reserve is making. The interest earnings on the core portfolio was $828,000. Total interest earnings for the year across all funds was $3.4 million, and we had $1.2 million earned the results of gains on sales of securities. So total revenues generated was $4.6 million compared to 21, which was $3.7 million.
What is the current value? It's about $1.2 billion.
The total portfolio right now, it hit $2 billion earlier this week.
Okay, I'm sorry, I can't read this.
Yeah, it's higher than it was.
Old age is catching up with us.
Last year, the high point was 1.8. We're at 2 billion. It's a little higher this year than last year.
All right.
I haven't had a chance to tell the CFO yet that we hit 2 billion the other day. It was earlier this week. So we're at 2 billion. It's come back down. It's about 1.9 right now. It's constantly changing as we pay bills. So the next part of the report really lists the contracts that we have in place. We have a contract with PFM as an investment advisor that will expire in December 2024. Our bank contracts will expire in March. We're working through the process right now to get new contracts in place for banking services. And then I list the finance committee members, and this is as of June 30. So these are the committee members, and of course I offer our sincere appreciation to the Finance Committee for all the work you do in helping us and providing expertise. The rest of the report is reports you've seen before. This is the PFM report as of June 30th. And I'm not going to spend time going through each one of these because you've seen this information before. But if we scroll down a little bit further, you get to the report that the district did for June 30th. And then we have all the reports coming from Florida Palm, Florida Prime, the 3 money markets. And then at the end, we have the money market questionnaires. Our policy states we're supposed to do that whenever we choose a new money market. We do it annually, and I'm actually working towards updating that, so we're doing it quarterly. I want to make sure we're monitoring those funds to make sure that nothing has changed. It's being managed the way we expected it to be managed. And then at the very end is the investment policy. This is a very large document. So we just keep going. It lists all the securities. It's over 200 pages long, policy. So as I said, I'm not going to go through every line item. We haven't even got to the policies yet. So it's the annual report that summarizes all the investment activity. Here's what the money market questionnaires look like. This is one, and that's the policy. The money market questionnaires are here. And there's about 10, 11 questions that are asked, and we do one for every fund. This one was for State Street Institutional Treasury Plus Money Market Fund. So this is available online, and we'll be sending that to the school board so that they see it. We're required to send that to them annually. Are there any questions on investments? Okay, so I want to go, the next item is the annual debt report, and you see this once a year as well. And I'm going to go through this one pretty fast also because I don't think there's anything in here that you're not very familiar with. You start off with, it all ties back to that debt management policy, which is included in the report. The goal is to obtain capital at a low cost while managing the portfolio risk, any type of risk. Our ratings have not changed, and I want to talk a little bit about ratings in just a minute. It talks about our debt is short-term and long-term. At this point, the short-term debt we usually issue is a tax anticipation notes, and we did not issue that last year or this year. So it's just long-term debt that we have. I again listed all the committee members, and there is a report in this presentation, but it does show since the Finance Committee was established in 2001, we've completed 88 debt and hedge transactions totaling $8.2 billion. And the resulting savings on refundings and swaps is at $186.9 million. So it went up a little bit with the forward refunding that we did. So all of that, we couldn't have done those transactions if it hadn't been for this committee. 168 million, almost 169. So once again, thank you to the committee for all the work you do. I list the advisors. And then we have the underwriters, and the underwriters contract was just recently extended for one more year. There's a link to our investor relations page. And then this you have seen before. This is the history of our debt issue, why we do it. It was started back in '94, was when we started issuing COPs, and schools were way over capacity. And I promise I'm not going to read through this, but we issue debt when we need to build schools. That's typically when we need to do it, whether it's overcrowded due to student growth. Sometimes we need to replace schools. We've seen a significant reduction in the comprehensive safety inspections. We call that CSIR here. It's Comprehensive Safety Inspection Report, and it goes to the board every year. And you can see there were a lot of citations back in 2002, and you can see how that's dropped off. And a lot of this construction was funded with COPS, and it's helped to make our schools safer. We've also built in hurricane hardening, and a lot of other things have been built into these schools. We've listed the schools that have been financed with COPS proceeds. This was between 1995 and 2011. This is a bit of a history book of everything we've done. We do show this chart that you get to see every year that shows the value of the capital outlay millage. And you all know very well that was changed from 2 mils to 1.5 mils. The green line is 2 mils. If we still had 2 mils, we would have got back to the level of 2008 a lot earlier. Instead, we got back to that same level in 2022. So The revenue we received in 2008, we didn't get back to that until 2022 as a result of the reduction in the millage levy. We are showing that COPS payments were going down. There was some misconceptions in the public. They thought that whenever we did a refunding, a refinancing, we were extending the maturity date, and that was never the case. When we do a refunding, we always keep the original maturity date. We were just getting lower interest rates. So I added this because there was misconceptions out in the public. I wanted them to see that we really were reducing the amount of debt outstanding. We have issued some new debt in the last few years, so you're seeing it come back up, and we're continuing to pay off principal every year. And looking ahead, this is the most recent chart that we have. There was a significant rise in property values this year, which is that very steep turn, and then it levels off. But this shows the existing debt service. The blue bars are projected debt service that we expect to do going forward, and what we think it's going to be. Before we do any debt issue, we always bring it to the committee, and we look at the structure of the debt issue. At this point, we just start going through each of the debt issues. So we talk about capital outlay bond issues. We haven't issued any of these since 2011, I think it was 2011 was when they did the refunding. Equipment leases, that's the leases we did to purchase school buses and to accelerate some air conditioning chiller replacements. We only have 2 outstanding. The last one will mature in August 1st, 2024. Certificates of participation, brief explanation of that, and the summary of what we did in FY22, and that was the 2000A forward refunding that was done. I also mentioned that forward refunding that's going to happen in 2024, and then we did a debt issue in 2022, and we did one in FY23 already, so that's listed as a subsequent event. Qualified Zone Academy bonds, these have all been paid off. I'm very tempted to take them off the report completely, but QZABs come up from time to time, and the state says you can do this again, and this committee has said we shouldn't do that. I'm tempted to take them off, but there are no QZABs still outstanding. The QSCIBs are still outstanding. That was done in 2010, and I provided an update on the impact of sequestration. Federal government a few years ago said, instead of giving you all the money we promised to offset the difference between the taxable and tax exempt rate, they were supposed to give us some money towards that. It was supposed to be $51.7 million. It's been reduced. They keep reducing it and changing the amount. So the impact of sequestration to date has been an extra cost to the district of $2.1 million. It's projected to be $2.8 million. There are bills that float around from time to time at the federal level to say, we're not going to do the funding anymore. We're just going to stop doing it. So when that comes up, we look at it, we pass that on to our lobbyists at the federal level, say, please take a look at that. It would have a $9 million impact on the district if they did that. It does lead me to think that whenever the government comes through and offers a deal like this, when they're going to pay part of it, I'm very hesitant to recommend that. Because they can change their mind after the fact, and we're still on the hook for the payments. So that's one of the reasons I keep the QZAB on here. It's good history, and I don't really want it to go away. Short-term debt, there were no TANs. The revolving line of credit, that's for the sales tax, and we did extend that for another year. It will expire in July of 2023. Hedges, they're all gone. There aren't any hedges. They were terminated all as of 2018. Our debt ratings haven't changed, and at this point, this is pretty much the end of the document other than reports. But I did want to bring up a topic. We've got a debt issue that we're planning to do in the near future, and there's been several school districts lately that have changed the way they're doing ratings. There are 3 key rating agencies that rate school districts: Moody's, S&P, and Fitch. We're currently using Moody's and Fitch. We dropped S&P a few years ago, so we still have 2. There's been several school districts lately that have dropped to only 1 rating. They've dropped Fitch and kept just Moody's. Ratings are expensive. It's the most expensive portion of the cost of issuance. They're over $100,000 a piece to do ratings these days. So I did send questions out to all the underwriters in advance of this meeting to get feedback, and some of them said, yeah, you can probably get away with it, but you're doing larger debt issues. Our next one's expected to be about a little over $200 million, at that size, a lot of investors may want to see 2 ratings. And Laura may want to chime in on this a little bit because PFM is the one that brought it to my attention. And I said that would be a good discussion to have with the committee when we go over this.
Yeah, so we talked about this in consideration moving forward because rating agencies are so expensive. Unlike where we have, 5-year contracts that are put out to bid, they set their prices every year and the escalation is built in and it is what it is and it's based on par amount being issued. We have price deals recently, very successful deals. The market tone seems to be changing slightly from where it was earlier this year with just 1 rating from Moody's. And so Leanne and I talked about it with the name of Palm Beach Schools, with the ratings, which we will, continue to push to try and get an upgrade for the COPS. That, the consideration to be looking at in transactions moving forward, whether or not we utilize 2 or 1. And talking with the underwriters and their desks, having 2, there are a group of investors that require 2 ratings on there. There's many investors that are comfortable with just 1 rating, and so that's where, when they start to get into the size, if it's under 100 million, they're saying, sure, fine, 1 rating, because they don't have to go find more investors that are okay with just 1 rating, where essentially it would have to work a little harder to find the investors to go to 200 million that are okay with just 1 rating. And so we're not suggesting at this point, since we haven't reached out to the ratings for this upcoming issuance, whether or not, but we wanted to have the discussion with the committee to potentially, based on market conditions at the time when we go to engage, in coordination with the senior underwriter and their desk to make sure that they're comfortable with an approach, if given the market tone, it would be appropriate to potentially drop 1 of the ratings and save, the district some money. We would take into consideration, obviously, the impact on pricing, because, if the investors are backing out, but we did sell for another school district that was a AA2 COPS rating. There was over $2 billion of subscription for 120 million of orders. So and that was with 1 rating. So there are investors out there that have the appetite. Part of it's the structure, 10, 15, 20 years where you are in the curve to take that into consideration. But we thought it might be a conversation worth having.
Who is it that you use? Moody's now? And
We use Moody's and Fitch.
Fitch, but not S&P.
Correct.
And is there a reason for that?
S&P's understanding of Florida School COPS papers, I would say, is not as advanced as Moody's and Fitch. So I think Moody's and Fitch have a better understanding of the Florida School paper typically than S&P.
My comment on that would be I would prefer 2 ratings, and I would explain to our friends in the investment banking community that we expect them to have the net effective cost of that be 0 as far as so that they can find the buyers at a better price that reflect that. After all, $100,000 on a $200 million deal is not much.
Right.
And that's a modest contribution
What
that
do you
all
all
you
think?
gentlemen can make to us. Thank you.
Well, what's your view? What are your views on the double rating?
I mean, I shared this with Leanne and Laura. I think there's been 8 transactions done with 1 single rating. I'd say the average size of that was 60 million, with the largest being just 1 over 100 million. As you go into a larger size, 200 million, maybe a taxable component, paying less than paying less than a basis point for kind of that volatility safety buffer to kind of maximize the universe of investors willing to purchase your COPS, to me, is worth it. So I don't think I would advocate for reducing from 2 ratings.
Any others?
I think it's what Laura said, but I think it's a case-by-case basis because the market changes over time. Also, your transaction, depending on the structure and the dollar amount, changes. So I think with each transaction, you ask the senior underwriter what their thoughts are, and you go from there.
Do we get a different following when we don't use both? In other words, 1 rating agency going to keep up with us and the other not?
So currently, with both Moody's and Fitch rating the debt that's outstanding, there would still be surveillance provided by Fitch or Moody's. The consensus is if you go to one to utilize Moody's, but Fitch would still be doing their annual surveillance. And so it just depends on if over time, that debt expires, and that would be less review, less work for Leanne as well, that they're looking into that debt. But as long as there's debt outstanding with both ratings, the district would be talking to both rating agencies.
Yeah, personally, I think it's something to look at. I don't think I want to recommend it for this upcoming deal. It's a big one.
Changing.
Yeah,
You don't wanna
it's just
recommend.
switching it to one. It is a lot of money, but when you look at it in the scheme of things, it's not a significant cost percentage-wise in a borrowing.
Particularly if the investment bankers are going to pay for it, or
Yeah.
the investors.
It comes right out of the borrowing.
Yeah, right,
We pay the bill out of the
exactly.
borrowing.
Let them pay for it.
Yeah, so we build it in. It's just something that's, it's a twist in the market right now, and I wanted to bring it up because some districts have gone to one. I think it's valuable for me. I think I'm an odd person. I like doing ratings. I like talking to the rating agencies. Evidently, that's not normal, but I enjoy talking to them.
You
And
probably get insight, don't you?
I do, and they call me and ask questions not specific to Palm Beach, but what do we see going on? So I like having that relationship with both. They ask very different questions. When I talk to Moody's and Fitch, they're very different conversations. Both of them are valuable. But it's just something I wanted to bring up and have that discussion with the committee, get your insight, just like I asked the underwriters for their insight. Because it's changing. So if the market's changing, I don't want to ignore it. But at the same time, I don't know that I'm eager, especially for this deal that's coming up, that's going to be $200 million. That's a big rating, and the market was rough when we did our last transaction. Now it's fabulous I don't think I've ever seen a deal that we've done with $2 billion of subscriptions. That's amazing. And I hope I see that with our next deal. It just depends. The market changes from day to day. So this is not something that I don't think it's something that we want to change this based on market conditions, because market conditions are always changing. But it may be something, if the way investors are looking at debt in the long term is changing, it's something to consider. So we may bring this back to you. The conversation came up, and I said, we're going through the debt report, we're going to talk about ratings. I'll bring it up and get your feedback.
How about you, Professor? Professor Emeritus Bill, you have a view on this? Do you have a view on two ratings?
I can't understand you, Rick.
You're too close to the mic now.
Do you have a view on two ratings versus one rating? Two.
Okay.
And Mike?
I think it's smart to follow the market conditions, but I think if it's over 200 million, the market's going to tell you probably still need two.
Yeah.
You have any view, Barbara? Wow, that's an admission. Two ratings versus one rating on our bond issues and the effect that has, which is. I always look to Leanne on two. Okay, and Jack, is Jack on the line? We hear from Jack.
Jack is on the line.
What do you think, Jack?
When I was issuing large amounts of debt, now I'm going to give myself away. This was in the mid to late 1980s. I preferred more rather than fewer rating agencies. And in fact, that was when Fitch was just kind of coming up, and I was doing good-sized deals, and we encouraged them to come in and to rate our debt. This was telephone company debt, so kind of similar in terms of structure and quality to what Leanne is dealing with. So my preference is more rather than fewer.
So I think we're encouraging you to do more unless it's sensible not to.
Okay.
And you notice Leanne nodding. Seriously, I do pay close attention, but when we get into the real finance stuff, this previous math teacher, I feel like it's another language, so. but you see me taking notes periodically, which I will ask Leanne about
Hey,
later.
listen, you're not the only one.
Forgive me.
That has it.
Oh, I am absolutely the only one in this room, except maybe my colleague next to me. But thank you.
Okay, so the rest of this is the reports. We have, the first one is the one that's required in the debt policy, and I know it's a little bit hard to read. This is, and a lot hard to read. I usually print this on 11 by 17 paper. It's really great to have it online, and I use it in Excel, quite frankly. But for every transaction, it has the name, the date, who the senior manager was, the original par, how much is outstanding as of June 30th, and I have August 1st because principal payments happen August 1st. Final maturity, if it's fixed or variable, and all of ours are fixed at this time. If it's a new money transaction or a refunding, the interest rates, that's the coupon rates, not the yields. The issuer ratings, the school district ratings. We used to have the insurer ratings, but we don't have insurance on any of them anymore. Call provisions, the purpose of it, it was refunding a certain transaction or it's a new money transaction. If there's any exposure to market change, if it was a public offering or a direct placement, if it's hedged, and we don't have any hedged transactions. So we have this for every current debt issue that has bonds outstanding. If it shows nothing, those are ones that matured this year, so they needed to stay on this report, but they'll fall off the next year. So it shows all the COPS first, and then it has the 2 equipment leases, and then these are the capital outlay bond issues that are issued by the state. There's 2 of those left. So that's all of our debt issues, and I use and rely on that report quite frequently. This is just a list of all the transactions that have been done. So the type, the issue date, the amount, if it was new money or refunding, the amount of swaps, total transaction, and the PV savings. And the count is just so that at the bottom, I can get a count of how many we've done. So there's the 81, and there's the 168.9 million of PV savings that we've achieved. So this is the list of things the committee has done on the debt side. And then we have a list, we call this the master lease summary schedule. We use this, and Blair uses this quite a bit on the legal side. For every debt issue, it lists each individual school, so we know what's included in the master lease. And it has the number of student stations, the number of square footage, the original par, again, how much is outstanding, the asset versus non-asset. So this becomes very important when we get a phone call that a school wants to name their stadium. It's difficult to do that if we have a ground lease on it, or if we want to add a cell phone tower, or we're thinking of selling a parcel or adding an addition. I call Blair and say, how much of this, where we want to put it, is it part of the ground lease? And I'm going to miss him. He's retiring soon. When is your last day again? End of May. So we'll have to wish him well come May, and I'm really worried. I want to get this next COPS issue done before he leaves. So that's what this report is, and we use this on a regular basis. This is in Excel, and it actually is much bigger. We're also tracking impact fees here. We're tracking lease revenues, because part of doing tax-exempt debt, if we're leasing space out, we have to track it, and we have to have a maximum amount of revenue that can come in for each school. That's all built into this same spreadsheet. You don't see all that detail, and believe me, you don't want to see all that detail, but we need it, and we use it. And I think the last thing is the schematic. We were just joking. This is what we call my birthday present, because the first time PFN did this for me, they gave it to me on my birthday. So every year I get this report from them. And it lists, you go down to the bottom, and this you have to have on a big sheet of paper. They just handed them to me, so it's on 11 by 17 and laminated. And it starts with the debt issue, the original debt issue, and then you can follow the arrows up to see when it was refunded, and call dates and any other terms. So you can follow from one debt issue with your finger and follow through to see if it's been refunded and what the current debt issues are. So this is a valuable tool that we use. It's very hard to see on the screen, but it's a document that we have, and I include in the annual debt report. And that is the end of that. The only other thing here is the policy. We attach the policy at the back.
And we'll review that policy.
I'm going to bring the policies back. Hopefully the next meeting, we've got to do a little bit of work on those. They'll be sending them out. Our team of underwriters will all get a copy of it. The bond counsel will get it. The investment advisors see it for the investment side. I ask for their feedback if there's anything they're aware of that we need to adjust. And we do that every year, and we bring it to you. The difference this time is, even if we don't have substantive changes, I'm still going to take it to the board this time. It's been 5 years, and I saw Ms. McQuinn nod her head. She agreed.
And we have one, I guess just one new school board member, but who will want that information too.
So we're planning that. It may take a while to get it on the board calendar because it takes a while to get through policies. There's actually, we'll do a board workshop with them, and then there's 2 public hearings to make changes. So it takes 3 to 4 months and getting it on the calendar. But the first step is bringing it to you. So we'll be bringing that at the next meeting for both of them.
So one other item, Steve Alexander was supposed to be here.
Mm-hmm.
We were supposed to honor him along with Bill here. Can we get him back?
I will ask that question. He has the flu, and he's really miserably sick right
And
now.
we want him when he's healthy, frankly.
Yes, by all means.
I'll
But
see if
let's
I can get him to come
yeah,
down.
Yes, let's have him come around, celebrate him too, get another breakfast that way.
Save some of the breakfast for him.
Pardon me?
Save some of the breakfast for him.
Yeah.
That's right.
We'll take them back to Orlando with us.
Right.
And thank you, Richard, for picking up where Steve has left off. He's been fantastic
Absolutely.
for many years. How many years?
Well, I worked with him, as long as I've been at the district, I've worked with Steve. So I became the permanent treasurer in 2001, and he helped us write the investment policy and update it. And he introduced me to David Moore, who we had as our debt advisor for years, and now Laura is doing that work. So we've been working with them a long time, and I've learned a tremendous amount from the whole team at PFM across the years, but particularly Steve and David, who we honored last year. It's been a great teamwork, and we've got great people coming behind them. PFM has done a great job at, when David got ready to leave, it was a year in advance where he said, I'm not going to be your lead anymore. You'll work with Laura. And if there were issues, I could call him. And it was a really good handoff. And they've done the same thing on the investment side, that there's no lapse of service at all. We have a good team there, a lot of depth.
One other note of recognition for Steve Alexander. I'm not sure I have this right, but I believe he was elected either chairman or president of the Board of Trustees of Stetson University.
That's his
Oh,
new
really?
job.
Yeah,
that's
so
great.
he's way up there. He's taken, this is his retirement.
That's terrific.
Yep.
No, that's
So let's do a resolution for Steve.
absolutely.
Do
let's
one
do a
for as
resolution.
minor character as I. We can do one for a
Sure.
giant such as he.
Let's do that in honor of Steve.
Absolutely.
You got some
Yes, so
wording?
moved.
Okay, well, we'll figure out the wording, but let's do a resolution honoring Steve and for his good service, just like Bill.
One last item, if there ain't anything further. I just wanted to tell you, at least in my view, and I think it's shared by everyone, all of the board members, that we are really so pleased with the quality of the work that Leanne and everybody associated with the Treasury operation does over the years, and this is just another example of it. And you should be commended and wished a very happy holiday season.
Thank you.
I'd agree, and how would you compare it with the corporate entities that you deal with?
Oh, I think she's the best.
Congratulations. I
Thank
agree
you.
with that. I think you're super.
Thank you.
In fact, this whole
Right.
this whole crew, and your backup is super.
We have a good team. We have a good team. Thank you.
And Mike Burke, to be commended too, your former finance
Yeah,
guy.
I'll send
who's
the entire.
Executive. as
Yes,
the chief
indeed,
executive.
the entire staff of the school board, but particularly the Treasury
Yeah.
people.
Okay.
Really.
Oh, we have a question?
I have a comment, though, about it in Heather. Heather does a very nice job of explaining. We just had a budget workshop, and she does a great job of explaining where we are and what we need. So we have an incredible team.
Yes,
But I will
agreed.
say that Steve Alexander, that I never met in person, but Steve Alexander is the one person who really speaks in layman's terms that I can understand. So we need somebody who could, even Leanne, who tries to explain it to me. The more she tries to explain it, the more confused I get. So,
No, I've got to work on that.
Leanne is a detailed person, we all know.
I think Mr. Warner has his hand up.
Leanne, just housekeeping, sorry, I don't know that we had a formal roll call. So I just want to be sure that the minutes reflect my attendance, albeit
Yeah, we didn't
virtually.
get to that. That's when I noticed you on the board there. I'm sorry about that.
Yeah, at the end of the meeting, I get an email that lists everyone that attended virtually. So I certainly, and I know you're there. We've talked a couple times during the meeting. I'll make sure you're included in the minutes.
Fine, thank you.
Thank you. Okay, so I do have the future meeting dates, and I think I sent those all out to you. If not, I'll double check to make sure you got them all. I was sending out meeting invites for Finance Committee and for the Sales Tax Oversight Committee, and I think I stopped in the middle and went back, and I want to go back and make sure you got them all. But the committee members all have this as a hard copy. It's online.
Right.
I'll make sure you have them as the future meeting. The one for the TAN, that meeting is the one that we often cancel. I like to get it on the calendar in case, and I'll let you know well in advance if we're going to cancel it. So that's the
So,
future meetings.
Will you look to the February 17, 23 for Steve Alexander as a possible?
We'll ask him if he can attend that meeting. And that'll be the meeting we bring policies back to you, and we'll have the December 30th quarterly investment reports. Okay, so I'd like to thank all of you for coming today.
Thank you.
And thank you once again for your support and all that you do to help us do what we do. We really couldn't do everything without you, so thank you so much.
This has been an excellent committee, and Bill, you've been a big contributor to it, and much appreciated. Farewell to you.
Thank you specifically, Dr. McDaniel. We really appreciate it.
Are good for you.
Yep.
Happy
So
holidays.
thank you and happy holidays.
Thank you.
We'll see you all next year. Is the meeting adjourned?
Meeting adjourned.